Imagine a neighborhood where a once sturdy house suddenly starts to crumble. It's a concerning sight, and your neighbors can't help but wonder, could their homes be next? Well, in the world of economics, nations are like neighbors, and when one of them faces a housing crisis, it can set off alarm bells across the continents. Today, we're going to take a closer look at Sweden's housing market, which is going through a bit of a rough patch. What's happening there isn't just a local issue, it's got the potential to impact the financial landscapes of other European countries. So grab a cup of joe and join us on this journey as we explore the factors that might turn Sweden's housing crisis into a European headache. We're gonna delve into the details and figure out why Sweden's housing market is in turmoil and what that might mean for our European neighbors. There's a lot to unpack, from rising debts to sky-high interest rates, and it's all connected in a way that could send shockwaves through Europe. So stick to proper protection to get an outlook on what might be coming Europe's way. Now, to comprehend the gravity of the situation, let's delve into the current state of Sweden's housing market, examining key statistics and the factors that have propelled it towards a precipice. Sweden's housing market has been on a roller coaster ride in recent times. The average house prices, which once soared to dazzling heights, have experienced a significant downturn. According to data from the Organization for Economic Cooperation and Development, house prices have plummeted by approximately 1/5 since their peak in March of 2022. This downturn is particularly striking given Sweden's reputation for a robust and stable housing sector. However, the housing market's woes extend beyond just declining prices. It's crucial to consider the broader economic context. Sweden's household debt levels have been rising, casting a shadow of concern. Swedes now find themselves burdened with debt levels twice as high as their German or Italian counterparts. This debt issue is intricately linked with the housing market's instability, as we'll soon explore. To understand the driving forces behind Sweden's housing crash, we have to first acknowledge the role of rising interest rates. Sweden's central bank, in its pursuit of taming inflation, has embarked on a path of interest rate hikes. Since 2020, the bank's policy rates has surged from 0 to 2.5%, inflicting a significant impact on borrowers. The high proportion of floating rate mortgages in Sweden, where interest rates are tethered to the central bank's rates, has made home ownership unaffordable for many. As interest rates soar, the cost of servicing these mortgages becomes increasingly burdensome. The result? A sharp dip in housing demand, driving down property prices. Economic challenges further worsens the crisis. Rising costs of living, including food, fuel, and energy, have only added fuel to the fire. These soaring expenses have eroded consumer confidence and purchasing power, further stifling the housing market. But Sweden's housing market crash isn't just a localized hiccup. It's sending shockwaves through the nation's economic landscape. The way this is affecting its local economy forces a look at the past and how historical experiences are shaping its response. Consumer spending, often seen as the lifeblood of any economy, has felt the tremors of Sweden's housing market woes. As property values tumble, homeowners find their wealth on paper dwindling rapidly. This erodes their confidence, making them cautious and risk-averse. Rather than splurging on discretionary items or investments, many Swedes are cutting back on spending, a trend that can ripple through various sectors of the economy. Moreover, the wealth effect comes into play. Historically, as house prices rose, so did consumer confidence and spending. Conversely, falling property values have the opposite effect. They can generate a vicious cycle of reduced spending, slowing the economy further. The stability of Sweden's banking sector is also in the spotlight. Swedish banks, which have a substantial exposure to the housing market, are feeling the heat. Swedbank, for example, has a staggering 1 trillion crowns or $97 billion in mortgages and loans, with another 240 billion crowns or $29 billion in loans to property management companies. This exposure raises concerns about potential losses and the stability of these financial institutions. However, it's worth noting that the Swedish Financial Supervisory Authority remains confident in the resilience of Swedish banks. Stress tests have shown that even in a reasonable worst-case scenario, bank losses would be limited to less than 1% of outstanding mortgage debt. Sweden's history serves as a sobering reminder. The collapse of a housing bubble in the 1990s triggered a chain reaction that led to the nationalization of two banks, the bailout of a third, and a deep recession. These painful memories have left an indelible mark on Sweden's approach to the current crisis. But the government is prepared to act, echoing its past efforts to safeguard stability. In the 1990s, it issued guarantees to restore confidence. Today, Sweden's debt office asserts that the country's low government debt and financial strength provide the capacity to intervene and bolster the property sector if necessary. This could involve credit guarantees or subsidized loans, reflecting the government's resolve to prevent a repeat of history. The economic world has become increasingly interconnected, though, with financial systems and economic conditions transcending national borders. Now, let's explore the contagion risks stemming from Sweden's housing market crash and identify factors that could amplify its impact across other European countries. One of the primary channels through which Sweden's housing crash could affect other European nations is its interconnected financial systems. In an era of global financial integration, banks and financial institutions often hold cross-border investments and assets. Swedish banks, for instance, have substantial exposure to the property market not only within Sweden, but also in other European countries. This interconnectedness raises the specter of a domino effect, where problems in one country's housing market can quickly spread to others. Another factor that heightens the contagion risk is the similarity in economic conditions across Europe. Several European countries are grappling with issues akin to Sweden's, such as rising household debt, soaring housing costs, and economic challenges. These shared vulnerabilities create an environment where troubles in one housing market can serve as a warning signal for others. Several European nations are already experiencing their own property market troubles, making them potentially susceptible to the influence of Sweden's situation. For one, Germany is among the countries hit the hardest by the European property slump, according to Eurostat. Its housing market has shown signs of vulnerability, with concerns over inflated property prices and increased household debts. Norway, like Sweden, has been grappling with rising house prices and household debt as well. It's witnessed a cooling effect in its housing market, and the risk of a housing bubble burst looms. As Sweden grapples with its housing market crisis, international organizations and policies come into focus as potential tools for addressing the challenges and mitigating contagion risks. The European Central Bank holds a pivotal role in stabilizing the European financial landscape. In response to Sweden's housing crash, the ECB may consider adjustments to its monetary policies to counteract any potential economic downturn. These adjustments could involve lowering interest rates or implementing quantitative easing measures to inject liquidity into the market. Such actions would alleviate some of the pressure on European banks and financial institutions exposed to Sweden. The OECD also plays a crucial role by providing valuable insights and recommendations to its member countries. In this context, the OECD can offer policy advice not only to Sweden, but also to other affected European nations. By sharing best practices, conducting risk assessments, and providing policy guidance, the OECD can assist countries in navigating the challenges posed by housing market crises. When it comes to monetary policies and financial regulations in Europe, a coordinated response is essential. The monetary policies of individual European countries and the ECB will be critical in stabilizing the situation. Coordinated measures such as adjustments to interest rates can help contain the crisis. Conversely, a lack of coordination or disparate policies may only lead to exacerbating the contagion risks. But now, let's talk about what you, as an everyday person, can do to get ready for the possibility of a housing market crisis spreading across Europe. While you might not have the power to control the entire economy, you can certainly take steps to safeguard your own financial well-being. First, build financial resilience. Create an emergency fund by setting aside money in a savings account for unexpected expenses, providing peace of mind during uncertain times. Review your budget, trim unnecessary expenses, and redirect those savings towards your emergency fund or debt reduction. And if you're considering buying a home, carefully assess your decision, taking into account factors like job stability and local housing market conditions. Renting can be a more flexible option during economic uncertainty. Understanding the broader economic context will help you make informed financial decisions. Additionally, another less talked about aspect is to educate yourself about your rights as a borrower or homeowner to access available protections and resources. Also, seek professional advice from financial advisors or experts. They can offer personalized guidance based on your unique financial situation and goals. Moreover, just try to remain calm and avoid panic. Financial markets experience ups and downs, so refrain from making impulsive decisions. Stick to your financial plan and adapt as necessary to navigate uncertain times with confidence. There's no shortage of options for policymakers to choose from, but with Sweden already having gone through a similar situation during the 90s, one has to wonder how they let it get this bad. Back then, the EU was still in its infancy, and the implications were not as devastating as it would be in this already sensitive housing and economic landscape. So the question lies with you folks. Do you think it's reversible, or is it too far gone? Be sure to let me know in the comments section below. In the meantime, make sure to keep it tuned to Profit Protection to stay up to date on all things related to the economy, geopolitics, and technology. You might even want to check out this other video we made where we discuss Germany's shaky economic decline and what that could mean for the rest of Europe. But before you go do that, make sure to like this video and subscribe to the channel so you never miss a single upload. As for now, that's all from us here, take care, and we'll catch you in the next one.